everybody. I'm very happy to see you and welcome here and happy to be here. It's my third time in Istanbul where I'm coming for business, and I have been on vacation multiple times, actually maybe 7 or 8 times on your wonderful resorts. So I'll tell you a little bit about Silicon Valley Bank and about my personal background. So Silicon Valley Bank started 35 years ago in Silicon Valley by the major Silicon Valley funds. They wanted to have financial institutions that understands the needs of their portfolio companies, of startups, that they have different dynamics, different needs, and also the needs of the funds themselves. So for 35 years, we focused just in one industry, that's innovation industry. And we have been successful. We have now over 65% market share for venture capital funds in the United States, and 50% market share for technology companies. So actually every second technology company that follows the venture model is a client of Silicon Valley Bank. We have over 30 offices everywhere where there is innovation ecosystem, the university, the funds are investing, so we're investing as well. We also have over $3 billion under management. We're a major limited partner in many American funds, and we also have made, I think, just a couple of fund investments internationally. So my personal background, I immigrated from Russia to the United States. It took me a while to figure out actually that I was in the middle of Silicon Valley. So once I did, I realized that I have a great opportunity and I wanted to be part of the technology ecosystem. That's when I joined Silicon Valley Bank. My previous experience was with banking as well, just not tech banking. So for 5 years, I was one of the bankers servicing the Silicon Valley, working with American companies, with American venture capital funds. And then I started to develop Russian-speaking technology communities in the Valley. And through this work, I had the opportunity to go back to Moscow and start a venture capital fund, which was called Runic Capital. It's still a very active fund, invests internationally. We raised $250 million from 50 various limited partners. I was the CFO operating partner, responsible for all legal, financial, operational, issues, dealing with the technology companies, with all the way starting from incorporation to exiting them through M&A. I was representing the fund. Then when I went back to Silicon Valley, because I was sending so many referrals, so much business from Russia to the bank, I was offered to join the global international group of Silicon Valley Bank, and I'm covering 4 markets right now. That's India, Australia, Russia, and Turkey. So my job is to go to those markets, establish relationships with venture capital funds, with the best technology entrepreneurs, with angel investors and early stage seed funds as well, be helpful to the ecosystem. We have a great partners here like Burak. Thank you for letting us join the conference and speak, and Endeavor, who has been our partner for many years in Turkey. So we try to be helpful, and especially our job is to find the best entrepreneurs who are interested in global expansion, who want to come to the United States at one point of time, and we want them to be part of our ecosystem. I think from Asra's conversation, I think I understood pretty well what your group of people is here. So basically, I'm assuming that many of you probably have entrepreneurial experience before realizing that you want to be the angel investment and technology space. You're probably at some level of thinking how to become an investor or set up the early stage fund. And the last one is actually important. You need to have a global vision and strategy. So I will address, I think most importantly, I want you and you want to be successful investors. There are various types of investors, as I'll talk about. And that's pretty much depending by your risk profile, right? What you can do, how much risk you want to take, how much involvement you want to do, and how much understanding you have of the businesses that you invest in. So before, if you're considering what kind of investments you want to make, what kind of investment profile you have, it's actually very important to ask yourself those type of questions. And all these 4 bullet points that I'm going to talk about, they have proven to have direct correlation with the success of your investments. So it has been proven, and you have much higher probability of success as the investor in technology companies if you have entrepreneurial experience. So if you have done the business, if you built the business, it might not necessarily be innovation business or highly technical business, but you basically have the skills of knowing how to execute, how to have the vision, how to hire the right people, how to solve conflicts, how to get the partners, how to sell the product, most importantly. So people who have entrepreneurial experience usually are much better angel investors than people who come from corporates. What I've seen in Russia and in Australia is that there are a lot of early stage investors who are former M&A people, former bankers. So they have very different approach, but this also works out well because, if you're experienced M&A banker, you're actually really, good at calculating risks, calculating outcomes, calculating the road to the exits. Those are the type of people also very focused on the, your positive outcome for the investment. So this is very important. And again, it doesn't mean that if you're a university professor, if you worked for Microsoft for many years, you cannot be a successful investor. I think it's just important to understand that there might be areas that you need to cover and learn and be able to help. So also prior investment experience also help. So it is the case with most venture capital funds. Let's say if it's a brand new fund and they even manage to close $100 million in capital, usually the first 10 million is like when they're making mistakes and actually make bad investments. It's important to learn on your mistakes and do the analysis and actually figure out the strategy. But just don't be scared. If you have prior investments, again, there is higher probability that you will be successful because you just have the experience. But again, just give yourself enough runtime. If you are committed or becoming committed to making angel technology investments, just give yourself enough runtime, understanding that the first investments you'll make might be not successful, and that's okay, right? So the third bullet point is actually, I think, very, very important. There is a direct correlation between successful investments and the amount of time you spend with entrepreneurs through all the stages of your investments. Very important to do the right due diligence, right? Just spend time, maybe on writing that memo, because writing the memo actually helps you to be structured about the due diligence process. Talk to other potential investors, talk to potential competitors, talk to potential acquirers, talk to people in business. So just spend enough time before you understand that it's a good investment. This is not the place probably to rush. And that's, again, multiple studies by universities have proven that time you spend on the deal or on your portfolio companies is directly related to the success of your investments. So you need to be spending time on and be actively involved through all the stages, while you are one of the primary investors in the company. One thing that I would say, and I've heard this from a couple of successful angel investors, so when they join the company, they put it as their goal to get the company to Series A. So they feel that that's where most of their expertise is. That's where they try to develop the network. After Series A investor comes, they think, okay, it's Series A responsibility to get the company to Series B. And then Series A investors have different skills, different networks, different capabilities, and a lot more capital. But it might be a very good idea for you as an angel investor, if you're committing the time and money to this company, actually have your own execution goal that you need to get this company to Series A, and then you can basically hand it off and then focus on other companies. But entrepreneurs need your help with this a lot. And mentoring is also the last thing, and then I think the whole Entrepreneur Foundation is built on this, is mentoring is very important. And that's related to your entrepreneurial experience, is that people need help just to talk through the issues. Even if you are not offering the solution, just to strategize, to have conversations, have introductions. They might have various issues, between relationships between founders, formulating the marketing strategy, formulating the messaging, the product. They need resources and they need your time as a minimum, just as the sounding board, just to talk to you. And if you actually can give solid advice and mentoring in this time, that's also directly correlated to the success of the successful investors. So this is also a very important chat that should help understand, what kind of investor you are. And usually I give the example, so I work a lot with startups, and I have different type of people coming and telling the stories. I usually don't invest. We as a bank do venture lending at a certain point of time, but at early stage we actually don't invest, right? But we go through the pitches so we understand the business. So sometimes in Silicon Valley, you need to understand where the risk comfort is for you. For example, if you have a founder and he comes to you and says, please give me $50,000 as the angel investor, and in 1 year, the valuation of my company will be, let's say, $400 million. I can execute so fast, and I am so good at what I'm doing. I have the right vision, I have the right network, I know how to do this, right? So if it would be me, doesn't matter who is in front of me, I just won't buy it, right? So my risk profile is much lower, and I wouldn't be comfortable. I would be much more comfortable with this traction, right? Where I understand the business, and I know the business will grow 20%. Again, I assume I'm not that great of a visionary, right? But I wouldn't be comfortable, and I actually, frankly, wouldn't believe, the founder who would say that he will execute on this hockey stick, right? That's what the hockey stick is. So you as investors, you need to understand what's your risk profile, because this is true Silicon Valley venture model, right? All the funds in Silicon Valley, they want to find the companies, they want to find the founders who come to them and who say, give me $1 million. In 1 year, the company will be worth $100 million. And in Silicon Valley, there is enough founders who actually can promise this to the investors, at least promise to give it the best shot. And there are enough investors in venture capital funds who will buy in and give them funds to execute this extremely aggressive strategy. Right, but not everybody is cut for this, and if you decide that you want actually here from Turkey to find those entrepreneurs who will take you all the way to Silicon Valley with truly revolutionary ideas, who will take a lot of capital, then you need to find for those extremely bold people who come and who are extremely aggressive with their goals, and they have actually the right experience to execute on this, right? Because a lot of people can say, I'll do it, but if he cannot answer how, then it's a problem. But he needs to have the right experience, the right character. You need to be very charismatic to find a lot of partners to raise additional funding to execute on Silicon Valley type of venture capital model. So again, there are other options. There are businesses that are not truly revolutionary, not truly disrupting other industries. They're just technologically enhanced. And you as an investor and the founder sometimes might be very happy if you give certain percentage of money, you are involved, you're helping, he's growing 25% per annum, he starts paying dividends, he is committed to this. It's just a different model. It's not venture capital model that's that is led from Silicon Valley, and that's not how Silicon Valley works. But it's okay. You will be a successful investor. The founder will be a successful founder. It's still very, very respectable. Nothing wrong with this. You just need to understand, what's your risk profile and the type of people you want to invest to, because the people who will be committed to the venture for 10 years and grow slowly and steadily, removing the risks, is different than this type of founder who will go very fast with a lot of risks, need a lot of funding. It's just different, so you need to understand this. So I think Azra covered some of this. It's basically the breakdown of various investors. So a lot of people from my friends, they call them fools. I don't think why they call them fools. I think it's just basically you believe in certain people, right? You believe in your family members, you believe in your friends, you believe in people who made money with you, even though you cannot make a solid strategy and have make 10 investments, you don't want to involve. It's still, if you believe into somebody, I think it's always a good idea to invest if you truly believe that the person will deliver because of his passion and because of the previous track record. So, so when I will be talking for the rest of my presentation, I don't think I'm going to break down into the early stage seed investment, angel, or family when you just write 1 or 2 checks a year. I'm just talking about the success of early stage investments into technology. So investment structuring. So in general, I assume, let's say you are the beginning investor, you want to start investing in technology companies, and you are thinking how to do this, right? So one of the options that you have, and again, Astra covered this a little bit, is to co-invest with other people. And in this case, it's actually really good because you don't need to think about legal implications. You don't need to spend time or money on structuring or talking. All you can focus on is just figuring out the companies you want to invest and the entrepreneurs you want to invest. So this, crowdfunding platforms, they grow enormously, and I actually think one of the reasons that Silicon Valley actually was on the upswing for the last 8 years, we didn't have any recession. There was some slowdown, but that's because the international markets actually come into Silicon Valley because everybody wants to invest into the best technology companies. So a lot of people internationally from Dubai, from Australia, from India, from China especially, they all go on angel list and they start following some of the leaders, and that's how they get their first experience. So they look at the companies that certain already established angel investors invest, and then they evaluate. There is you can move on your own time. You can choose the amount of funds you want to invest, but basically here you just join the syndicate. And in general, syndicates are a very, very good thing because actually for several reasons. Again, when you take the decision independently, it's actually very hard. The founder can be very charismatic. It's actually much harder to talk to yourself than to talk to somebody. You're just picking up the phone and discussing the risks and the opportunity with somebody. It actually evolves your own thinking. That's why most of successful technology companies, they all were funded by syndicates at Series A and by many investors at the angels level if they actually went through the angel levels. But we even as a bank, we always put a lot of value on the syndication because the company tends to run much better when they have syndicated investors. Invested just again because there is more form, it's run more professionally, people have a lot more conversations about how to do things, right, rather than the founder or just one investor agreeing intuitively. And just think about it. Let's say you're the only investor into the company. The CEO calls you, he can catch you at the wrong time, and he's saying, oh, I want to do this product launch in this way. Is it okay? And sometimes you just say, okay, right? Because you might not have the time at this moment or for whatever reason, right? However, if there are two important investors, you actually won't say, okay. So let me talk to the other investor. And just this pushes the company to the better solution. So that's why we as a bank, for example, we never lend to the companies that do not have investors, professional investors, right? Because we feel that for the bank, the risks are much higher when there are no professional investors on the board, where there are no syndication involved, just because a lot more conversations happening. Those conversations are properly documented. Plans are more formalized. Just when there are more people involved, it's just more consensus building is needed. And we as a bank like it at the later stage VC rounds, but that goes pretty much also for the angel investments. Also, when you put, let's say, 3 angels to support the company, you together have much more money to take the company to Series A. You have a lot more connections. So if it's 3 investors investing, right, rather than 1, basically you can open a lot more doors for those entrepreneurs, make a lot more introductions, give him more money. So if, let's say, the company needs just $100,000 for, to get to, let's say, Series A, to reach the milestones, if it's 3 investors coming, the chances of, executing on the plan are a lot higher because, the founder has 3 angel investors helping him, and that's a really, really big deal. Well, I'm assuming that the investors are knowing each other, that everybody is in consensus, right? Other than fighting. So investment structure is also very important at early stage. Frequently, you don't want to spend too much time on incorporation. Frequently, at early stage, the angels, again, I'm not saying right now about best Silicon Valley practices. I'll talk about on next stage what I see at the emerging markets at early stage. People just give money one-to-one because they just want entrepreneur to see and to get to the next milestone. And again, usually at angel stage, there is a lot of trust involved. So if you spend too much time figuring out structure, incorporating company, documenting, again, it will be legally correct. But again, because it takes so much time, and it's relatively not a big amount of money, a lot of people say, you know what, I just want to see how it'll work out. I don't want to take too much risk. So people just, give it directly to entrepreneur in the form of the promissory note, or if you decide actually to go through the company incorporation, then you can do this as well. But at emerging markets, I see it's a lot more trust happening. And again, at this stage, if he loses your money, he doesn't get back to you, you're not going to sue anybody, right? Nobody has funds to get back. So just too much legal structure actually is not helping anybody. It just takes everybody time and distracts actually from important thing that is, at this stage is building your product. So let's say you gave the money in certain form and the technology company, the founder, made the progress that he promised, and then he's ready to raise Series A or to raise larger seed round. So at that time, it's very important to incorporate correctly. Right, so if you're committed, so you want to invest, you want him to raise funds from other investors. At this time, it's very important, and our recommendation, again, talking from Silicon Valley and having the experience, is always to go offshore, where the company can structure the Series A round by Silicon Valley best practices in terms of the liquidation preferences and the various rights and various warrants pools and equity pool. A lot of things in the markets outside of US, those things are not clearly defined, and the local law actually is not meeting those requirements. So it's very hard for you to structure the investments. And then if you start to innovate as an investor with structuring too hard, right, the investment for the entrepreneur, it actually can prevent him seriously from raising follow-on rounds. And again, for the technology companies, when you give them the money, you know that he'll need more funds to come. And then it actually complicates things a lot. So there is a lot of public documents on Y Combinator, on 500 startups. If you just Google, I would just recommend to make as simple documents as possible, but use offshore jurisdiction. It can be Cyprus, Netherlands, BVI, Delaware Corporation. If it doesn't matter, but you need to use English law. You need to protect IP because the English law allows you, if the company is truly technology driven and the founder has innovative business model or innovative technology, he'll want to file the patents and to be protected. So unless you use English jurisdiction and the IP is registered into this offshore company, it's actually very hard for you to protect your investment later. So once you feel like, okay, the founder is great, we understand what technology is, you have some proof of concept that the sales will come, and especially if it's a global business with global ambitions and there is a need for the product internationally, you want to take the company to any jurisdiction where they can use English type law and structure to the best Silicon Valley practices, and those are very simple. It's actually good because to structure by Silicon Valley practices is much simpler than to structure drawing on your other industry experience. And most importantly, if you use English law, it'll allow your company to raise funds in the future. So, and this is not expensive. If you want to register BVI company, you need to know the service providers, obviously, but it usually doesn't take more than $2,000. You can do it all remotely. It's actually very, very simple. And then investment role. Also, you need to be structured about this and really, understand who is the entrepreneur, can you really add value. If you feel you can add value, then you can take as active role as you can, because the founder will value this. And I'll talk a little bit more about it on my next slide. Somehow it's not moving to the next. Oh, this way? Can you see me? Oh, where?
You're fine now.
Oh, yes, true. Okay, here. Okay, so this is a long list. And, you know, when I was putting this together, I actually think all of this is important. So first, as the earliest stage investor, you need to invest into the industry you understand well. So let's say, you know, I have 20 years of experience in banking. So for me, it would be the easiest actually to go and invest in the fintech. If I have, you know, if I chose to invest into something, you know, the best thing for me would be to invest in fintech, because through 20 years I was exposed to various problems. So when I would identify, or the founder comes and talks to me, it would be easy for me to understand what he's talking about, versus, you know, let's say robotics or artificial reality, virtual reality right now. It's obviously very hot, and, you know, sometimes it's much more interesting than fintech, for example, but I wouldn't be able to understand, right? So it wouldn't be a partnership. In most cases, I wouldn't be able to add much value. In banking, for example, in fintech, I have relationships, you know, across various countries at different levels, with different banks, you know, with different fintech companies. Just again, through my job over 20 years, you know, I was in touch with those people, and I can call them, I can ask for advice, I can ask for introduction, I can use additional valuable resources. So I think for the early investor, it doesn't matter where on the spectrum you will be, you need to start with the industry where you have most of the expertise. Choose comfortable risk profile, again, so it might be a, you know, different risk profile. You just need to know what it is and be consistent, right? So if you're investing in technology-enabled businesses, that's one thing. It'll take a lot less money. You need to talk to different type of your syndication partners, because with syndicates, it's also very, very important. If one investor in syndication wants just technology-enabled business that will grow 25–30%, and another wants to build a true unicorn, right? Obviously, there is a lot of traction. So when you build a group of the investors with whom you want to co-invest into the companies, it's important that you have the same risk profile, and the companies into which you invest have the same ambition and goals as the you know, what the syndication group is. So it's very important. Yeah, don't invest more than 5–10% of the net worth that you have. And again, so a lot of people are not ready. They want to do this, but they're not truly ready. And again, I've seen this when I was with Runic Capital. You know, the person comes even to the fund, commits LP investment. Next year he comes and says, oh, you know, my girlfriend got pregnant. Now I need a house. Can I please exit from the fund? So he really lets the fund down in this case. The penalties are very hard, and the penalties, you know, if you invest your own money, will also be very hard. If you have to disengage, if you cannot support the company through Series A, even if it's a really, you know, great founder, you know, it's, you know, he needs resources, right? And in most cases, what you gave to him initially will not be sufficient. But if he's doing the right things, I'll need more money. You know, he might have a real good opportunity to actually execute on his plan, but if you are not here for them just because, you know, you're trying to meet the mortgage payments or you need to put your kids through school, it's just not the right time for you to do this. You need to diversify. Again, nobody can pick up the winners. Some people, after many, many years, and once they have the good sources for the deal flow, they have just better deal flow, right? And they make better investments. But you need to have the strategy, the certain pace of investments. Let's say you invest, you know, one company every quarter, or you invest 2 companies per annum. But you need to decide based on the time you can commit to this and how many deals you can look at through your channels. You need to decide what your pace of investment is, and you execute, right? It's your business plan. This bullet point is also very, very important. And you need to research. But let's say a lot of companies, a lot of investors, they want to invest into the best company where there is a already proven model, right? And they say, oh, I would rather invest, 1% into the company post Series B, than take a real risk at the early stage company. But if they take 1% at a very high valuation, and then the company still have to close 2 rounds, they get so diluted. They never have a word at the table. They get diluted. They actually don't make any money. So the valuation is important, and the initial percentage of ownership is very, very important. So you should have your spreadsheets understanding various scenarios. So most people, again, it depends at what stage you come. If you come at idea stage or if you're coming at closer to Series A stage, but you need to have your metrics, and you should never go below the ownership percentage. That doesn't make sense, right? If you invest your significant amount of money at 5% and the valuation doesn't make sense, you will get diluted. Even if it's an amazing entrepreneur and the company is doing well, financially it will not make sense for you. So this is very important to figure out in a spreadsheet. So when you look, again, this more refers to the high-profile companies that want to go global, expand with the very sophisticated technology and innovative thinking. So each company you invest needs to have the potential to make 20, 30 times. Again, most of the investments will be written off, right? So the ones that will make it big need to return 20, 30 times. So unless every single company that you invest to have the opportunity to return this amount of money to you, then your model will not work out. Again, if you go on a different, much more de-risked model, right, where when you give less money and the company grows slowly and there is a lot of risk that are already removed, then this might be different. You may make few investments with much more guaranteed return. But for classical venture capital model, you need to be targeting to make 20, 30x on each company you're making. So the 2 that you'll make money on actually will return your invested capital. The other things I talked about, spend time on due diligence, structure offshore when ready, because if you don't structure correctly, it's actually not good, seriously not good for the company later. Syndicate whenever possible, dedicate time for mentoring. Make sure you introduce. The most valuable thing that you can do is the introductions. And that's why it's important you actually invest into entrepreneurs that you believe into, so when you do the introduction, you actually feel good, right? So you love the company, you love what they're doing. And that's why, for example, me as the lender, so I try to do all my introductions where I'm still really happy about the company, right? Because things go through up and down. When you go through the downside, it's much harder to do valuable introductions because, when you speak about the company, you want to be honest, you want to disclose the risks. So whenever I feel like there is a great moment that I feel really strong about the company, that's when I do most of my valuable introductions because I truly believe at that time that things are good. And another thing that I've seen over and over again, let's say you have a portfolio, 10 companies, you have 2 companies that are doing really well and they actually hardly ever come to you with problems because they're actually executing, while the companies that actually don't do so well, they come and they try to get your help to solve their problems. And you as investors, you end up spending most of the time on the companies that will not make it, right? So it's important to actually focus on the best companies in your portfolio because you are significantly improving their chances of success. The common mistakes, that's basically everything on the previous side, with the negative sign. But things that I especially see in markets like India and Russia. So you as an investor give $30,000 sometimes, right? And you take a lot of control from the founder because you give him very important, and it doesn't work. Again, the same study that showed that the success of the company directly correlates with the amount of mentoring. But if you actually try to correlate it with the control, where the founder will come to you for every single expense, for every single decision he's making, he's the founder. He's supposed to know better how to execute on his vision. So if you're becoming the main decision maker, your founder loses the motivation. Having too much control is actually not a very good thing. Investing outside of domain expertise, it's actually, what happens is that it's actually very hard for you to have a conversation with the founder, right? Because if you're not an expert in that area, he comes to you, he tries to present you with the problems, but you actually don't know what the issues are. So, again, if you are trying to build technology enhance, business in Turkey, that's fine. Again, if you have ambition for global technological business, you need to use best Silicon Valley practices. If that's not the goal, then it's fine. Spending too much on legal costs, I've seen this, people just really spend too much time on structuring correctly, opening the bank account, doing all the documents while the product's still not working. It's a waste of money, especially if, too early, it's not good. And not having long-term commitment. So I'll quickly, please.
You have to come further down.
Yeah. I'm not good with this. Maybe I should just wrap it up. Can you slide it one slide forward? This is my last slide. Yes, and I know I'm out of time, I'll run through the slide very, very quickly. So this is in case you start making your investments and you see you have a winner. You see you have a really strong entrepreneur. You have a really strong entrepreneur that actually wants to move to US. Usually it's, again, not in B2B space. Usually, he has a very strong consumer product on the internet. But you see he's having traction. He's getting customers all around the world. So it's very important to set him for success. If he moves to US, most of the companies, you probably have heard, all of you heard that most entrepreneurs, or 52% actually of entrepreneurs in the US are immigrants and they are successful. But they don't become successful as soon as they land in California, right? So they become successful after spending 10 hard years learning the network, working for major technology companies, making mistakes, failing in some businesses, and then they get to the successful business. So this lack of how competent and fast executing the founders in Silicon Valley are, it's a big thing. It's just a lot more sophisticated, experienced founders. So if your founder comes to US and starts competing with them, and he's underfunded and underexperienced, there is a chance that he will not be able to do this. So it might not make sense for him to move. Maybe it's better for him to execute from here, from Turkey, just get more resources and use other tools, but actually not establish the presence because it is expensive. Insufficient budget, I'm running really quick. You need to have at least $2 million before you send the founder to US, to Silicon Valley. You need to give him sufficient funding, otherwise he has no chance to compete, doesn't matter what the product is. Bad hiring decision, a lot of times companies are successful in Turkey, have 50 people, so they take the founding team and put it in Silicon Valley, they all have the same issues. It's not good, so one founder needs to go and he needs to find local people to hire. Laws are very, very strict in the US, it's very easy to screw up your visa. Wrong legal tax setup, good lawyers do this, but the company needs to have the funding to be able to hire good lawyers. Unrealistic goals, it's very hard. So they need to have funding for substantial runway, at least for a couple of years for them to really Americanize the company and be successful. And a few other things I'm not going to cover. So that's all, I think. Thank you for your attention. Yeah, happy to help if I can.
I'll just introduce you quickly.